Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. The key pattern here, unlike the American markets, had been, and I use this term very carefully as it might still be a false break, had been the purple highlighted mid-March to mid-May shallowy bearish shift pitch hook. Yesterday, the market tested the upper tine of this pattern, the first time since June last year, when it was still just a nascent pattern, closing just underneath it yesterday. Today, we gapped higher, since filled in, and we have seen prices use it as a base to push up to the next resistance above, and that's the congestion between 197.25 to 198.5, containing the July low at 197.25, and importantly, now the slowly declining gold long moving average, currently 197.75. This is a potentially transformative event, and I'll be watching it closely just in case of a false break. However, this is not the only pattern that is seen on this market. As I pointed out last week when I said, and I quote, "You see, we have two other patterns, both rectangle patterns. The first is the older September to November 2025 rectangle, between the congestion around the combined March 24 to September 25 lows at 187.75, specifically a congestion between 186.75 to 187.75. That is the bottom of the rectangle. The top is a congestion between 197.25 and 198.5, containing the July 21 low at 197.25. The second rectangle pattern is derived from the first and utilizes the same base. It has a closer top side based around the flatlining mauve medium moving average, which is currently 191.75, so significantly narrower." End of quote. Okay, so I'd like to deal with the second narrower pattern first, if I may, and that had, because it was a fairly narrow rectangle, a primary target you've got a primary target, it's just a primary target at 195.25 and a secondary target at 196.25. Both these targets have already been reached this week. The first and larger rectangle pattern had the primary target X up in the 205.25 area, the secondary harder to reach target X1 up in the 207.25 area. So we now have to see if the market can turn on the congestion between 197.25 and 198.5, containing the July, or rather take on the congestion between 197.25 and 198.5, containing the July 21 low at 197.25, and seemingly more important, slowly declining gold long moving average, currently 197.75. If it does, which it does look at the moment, then I should point out that both targets overhead are within an old congestion band, dating between December of 2018 and February 2019, between 204 even to 208. Minneapolis wheat. The market here, as I've said often in recent times, looks more in common with Paris milling wheat than Chicago or Kansas City wheat. However, first, I'd like to look at the larger picture. And here we still have an extension to a large pattern I spoke about 25 weeks ago, and ever since. It is now under severe threat when I said, and I quote, "We're also possibly on the threshold of a really big pattern, a December 24 to date possible cat's ears pattern. This is a bearish pattern, but the discussion for this which I have postponed for a couple of weeks, may be coming up and real soon, as we're about to trigger the downside opportunities of such a pattern. It is a longer term pattern, but I urge you to keep remembering this idea, as if we travel and stabilize a little lower than where we are, I may feel obliged to deploy it with all its ramifications." End of quote. Now, I stood by this pattern idea for the past 25 weeks. This pattern idea is now under threat. We are today farther away from triggering this pattern than we have been since formed in August last year. The catalyst for this move up has been the push up and close over the slowly declining long moving average, currently at 593. First close over this moving average since mid-July last year. Today the market has exploited that move and we have pushed up and clear over this gold long moving average, with now resistance above from the April 21 low at 606 even and the October 2018 high at 611 even. This all ties in with my thoughts from 5 weeks ago, a question I had and a question that has been the same in all that time in between, when I said, and I quote, "Question was and is the break higher at Christmas a false break or not? Right now it does look like it might be, but we still have maybe another couple of weeks to find out for sure. This leads me to what has developed since September, but really since mid-October, and that is a possible sideways rectangle pattern between the uptrend below and just under the gold long moving average overhead. This might become the immediate pattern to watch." End of quote. Well, that is what has happened. We have now, barring a possible false break, which seems unlikely at the moment, barring a possible false break, we're breaking up and out of the sideways rectangle pattern, currently 570 to 593, between the important dark blue September 2019 today uptrend below and the gold slowly declining long moving average that was above. Hence it's time to indicate possible targets for such a break higher of a primary target X up at 611 area, right on that October 2018 high, with a secondary harder to achieve target X1 up in the 616 area. London UK feed wheat. In early July last year, due to changeover, we had a very large gapping move higher, up and out of the previous large bearish shift pitchfork pattern. At the time, the 50% absolute Fibonacci line at 180.5 played an important part in capping prices, as you can still see on my daily chart, along with some added nearby help at the time from the purple July 23 to date downtrend, which is currently at 173.5. Since that peak, we've seen prices ease lower, moving eventually below all the moving averages in late December last year, and penetrating lower as recently as Christmas week, but not managing to stabilize down there. What is more important here, and this is key, is that we are still establishing the market longer term, establishing the market below the very important dark blue neckline extension on my daily chart, which is currently 168.80. It's a neckline to a pair of long-term patterns which I will detail shortly. Now, I also drew some weeks ago a bright green late January to mid-July quite shallow bearish shift pitchfork to hopefully show the newer bearish angle of attack. In this pattern, the market is in between the bright green upper time above, currently 174.80, and the bright green middle time below, currently at 152.20. To be honest, this pitchfork has been disappointing, and as I said 7 weeks ago, and I still quote, I really don't think this pattern adds much to the conversation right now. End of quote. This leads me to my final thoughts, the same points I've been discussing here for well over a year, as some of them were something that I noted back in my annual commentary back in January 2025. To see these, it's best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 23 to April 25 bearish cat's ears pattern, akin to, say, a double top, but formed after a big fall such as the fall we had in early 2023. As well as this, we had an even longer term second pattern, an August 20 to April 25 very large head and shoulders top pattern. These two super long term patterns both rely on one single feature, and that is their common neckline, which is highlighted in purple on my monthly chart, currently 168.80, the same as on the daily chart I just spoke about. Thus, from these two longer term bearish patterns, we have a primary target X3 for the bearish cat's ears pattern, we down in the 127.5 zone, and a secondary hard to reach target X4 down in the 112.85 zone. But head and shoulders top, we have an even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 200 or so charts. The 1975 to date, yes, a half-century old uptrend, currently at 66.15. I'm not even going to give you my secondary harder to achieve target for this pattern as it's below zero. Please, please, please bear in mind that these are very long-term targets, stretching possibly over many, many years. But they are still targets below for these patterns above. Now, that all being said, July 2025 with changeover threw a major spanner in the works for such long-term patterns. The reactionary immediate countering monthly key reversal up for July last year went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5 and just under the bright green 2023 to date upper bear channel line, currently 174.55. The question this posed, and it's a longer term question, is whether this was just a reactionary single month move higher or the beginning of something else. Once again, as in my previous commentaries, I'll continue to stick to the reactionary single month move higher despite this week, and I waited a little later today to confirm this by producing this a video commentary, despite this week making a weekly key reversal up. So just bear that in mind. The action up to now did not look like forming a strong enough base. Not yet, but I am more prepared today than in previous weeks and months to start looking at the possibility of a new base of support. There is one caveat to this basing higher idea, it's one I've already mentioned, and that's the bright green mid-2023 to date big bear channel, currently 127.15 to 174.55. Even with such a big reactionary move back up mid last year, we are still sitting within this big bear channel, and it does have the advantage of already having had at least the minimum 5 touches necessary to legitimize it as a bear channel. For all this discussion, we are still dealing here with some very, very long-term patterns, and should please bear that in mind. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.